Pull up her awesome. We're gonna go ahead and start this now. But I would love to introduce Katie Lawson to you. Katie is a native of South Carolina. She holds a Bachelor of Science in Accounting from the University of South Carolina. Following a career as an assistant branch manager at a large corporate bank, she pursued her true passion for taxation. Earning a law degree from North Carolina Central University, go Eagles, Katie further expanded her expertise with a Master's of Law and Taxation from the University of Washington School of Law. And since 2008, Katie has been dedicated to practicing tax and corporate law with a focus on tax controversy. Her commitment extends beyond the courtroom as she passionately represents businesses and individuals, specializing in creating and fostering the growth of small businesses. Katie actively engages with the community by conducting seminars in collaboration with the IRS and local technical colleges, just to name a few. And she also helps individuals on tax and corporate matters. She has a wonderful reputation for quality, respectability, and integrity. And Katie's practice is centered on providing tailor-made, targeted solutions for diverse tax and corporate needs. So you all, please help me welcome Katie Lawson. Put in the chat, welcome Katie. And without further ado, Katie, I will give you the floor.
Thank you so very much. And I just want to first thank all of you for being here today. I certainly appreciate you taking time out of your busy days. And I know exactly how busy it is running a business and running a business. So I appreciate the time spent with me. So before we get into it, I have to read this statement because I am a licensed attorney. The information presented here is for educational purposes only and does not constitute legal advice, nor has an attorney-client relationship been established. So without further ado, and thank you everyone for the warm welcomes. So today we're going to talk about tax. And get to the next slide. This is going to be our framework today. We're going to talk about the most common types of taxes that small businesses face. Income, self-employment, employment, excise, and estimated. We're going to go through each of those. We're going to first start with income tax, and we're going to talk about income tax as it relates to each type of business entity. And then I'm going to give some tips and just some advice in regards to each of those entities as well. We're going to talk about self-employment. And then those of you who have employees or are looking to hire employees, we're going to talk about employment taxes, what you need to know as far as taxes, regarding taxes when you hire an employee. And we're going to talk about estimated taxes because some of you may have received, when you had your tax returns prepared, received like these 4 little vouchers that say that that breaks up a payment into like into 4, and it says for the next year. Those are estimated taxes, and if it hasn't been explained to you by your tax preparer, I'm going to explain to you the reason why you received those vouchers, and what you're supposed to do with those vouchers. Excise tax. I'm not going to go into that for we're just going to touch on that because excise tax relates to certain business types. And I want to just make sure that if we have some of those certain business types here, I want to introduce it so that if you have any questions in regards to excise tax, that you can ask that in this session. Okay, so if you have any questions throughout the presentation, please feel free to ask questions. I would like to make this as conversational as possible. With that being said, let's start with the limited liability company. So the limited liability company, or the LLC, is what we call a creature of state statute. This is a business entity type that is not found in common law. And what I mean by a creature of statute is that a state statute actually, a state law actually had to pass to create an LLC. So the LLC is a business entity in each state by that state's individual law. I'm going to give you a little bit of history on the LLC. So the LLC is traditionally a foreign business model. Before the LLC was enacted in the state of Wyoming, that was the first state that enacted the in LLC statute, there were only common law business entity types, meaning that there were sole proprietorships, partnerships, and corporations. Well, of course, those were very limited. So with the corporation, you had unlimited liability, meaning that the liability rested at the corporate level. But with the sole proprietorships and the partnerships, you have liability that rest at the business owner level, meaning that the business owners could be sued personally. So there was a need in between to have a business entity, a type of model that enjoyed the limited liability, the liability of a corporation, but then have the simplicity as far as operation and tax wise as a partnership and a sole proprietorship. And so here comes the LLC. So the LLC was studied by some of the representatives in Wyoming. They studied the model. And in 1977, they presented legislation to the Wyoming lawmakers, and the lawmakers passed it and approved it. And then at that particular point, the LLC became a viable business model in the state of Wyoming. And what they saw is that the trend was a lot of small business owners actually flocked to the LLC because of the limited liability and also the simplicity as far as tax and corporate matters. Well, over the next 30 years, all of the states in the United States follow suit. So the LLC was established, I think the last LLC statute was established in like 1992. So it's been around it's been a staple here for, at least the past 30 years here in the United States. But it has become the most popular business model because it is very, very small business favorable. Meaning that it gives you the protection of a corporation, but you're taxed as either a partnership or a sole proprietorship. So it gives you the ease of operation with the liability protection. And so the way that an LLC is taxed, and I often get this question, I have an LLC, should I file a separate tax return for an LLC? Well, not necessarily. It all depends on how many owners you have in the LLC has, how many owners or members that the LLC has. So if you have a single member or a single owner LLC, then by default, you are taxed as a sole proprietorship. And what that means is that you will file your income from the LLC on Schedule C on your personal tax return. If you have more than one member or more than one owner of an LLC, by default, it is taxed as a partnership. The reason for that is because on the federal level, because the LLC was created by state statute, on the federal level, the LLC is deemed a disregarded entity. So the federal level doesn't recognize it. So it goes to, it depends upon the owners, how many people owns the LLC, and then it goes to what it falls in under the federal level as far as based on the ownership. And I use the term as a default classification. It's either a sole proprietorship or a partnership, because as we will learn as we go through the material, is that you can elect the way that your business is taxed. So you do not have to stick with your default classification. Any questions in regards to the LLC before we move forward?
I do see one hand, Katie.
Yeah.
Kathy, feel free to come off mute or put your question in the chat, whichever you would prefer.
Okay, so with the LLC, since you're not electing, and if you're going with your default, you are let's say you are a multi-member, I guess. And I guess when I'm saying multi-member, I'm meaning partnership. So let's say you stay with that, then are you filling out the, I guess it's a 1060, whatever you're filling out, are you passing such that each member is taxed? Are they passing like K1s on to the members, or and they're filling out instead of filling out a regular 1040, they're filling out a 1065 or something, whatever, and then passing on a K1 to them?
So, and that is correct. So if the LLC has multiple members, then by default, that LLC is a partnership. And as a partnership, the LLC will file Form 1065. That's the partnership income tax return. However, with that partnership tax return, it's an informational return only, meaning that the partnership itself, the business itself, does not pay any taxes. So the way it works is that the partnership will file Form 1065, and then the partnership will issue schedules, K1s, to each of the individual owners. The individual owners will then take those K1s and report that income on their individual tax return and pay taxes at their individual tax rate. Now, one thing I do want you to keep in mind, that even though the partnership does not pay its own taxes, even though the partnership doesn't pay its own taxes, if the partnership return is filed late, then the IRS will assess penalties against the partnership for filing the return late. The partnership tax return is due a month before the regular tax filing deadline. So instead of April 15th, the partnership tax return is due on March 15th. And that's just to allow the partnership to produce those K1s and distribute those K1s out to each one of the owners. Now, and that leads me to one item, 1099s and W-2s. And I want to make sure that each of you know about the deadline. So you have until January 31st to produce and send out W-2s and 1099s to your employees and contractors. They do not have to receive them by January 31st. You just have to make sure that it's postmarked or sent out by January 31st. And I'm getting a couple of questions from clients. Do I physically have to file them, or is electronic delivery acceptable? Electronic delivery is acceptable, but just to cover yourself, I always advise my clients to make sure, if you're going to do electronic delivery, make sure that the person receives it. All right. Any additional questions before we move forward?
No, that's all for me. And you explained that wonderfully, and the best I've ever heard it explained. And so thank you for that.
Oh, no, I thank you, Ms. Gaines. Okay. So let's talk about a partnership. We talked about a partnership in regards to the the LLC. But if two or more people come together just in the pure form of business to join a business, then that forms a partnership. And just like I stated earlier, the partnership files a Form 1065, that's the partnership tax return, and issues Schedule K1s to each of the owners of that partnership. And then the partnership then files, then the individual owners then file those Schedule K-1s on their 1040s and pay taxes at their individual tax rates. So now let's talk about an S corporation, because I know that this is, and I've been hearing this a lot. Oh, your business needs to be an S corporation. That a lot of accountants and a lot of tax preparers have been advising individuals to make their businesses S corporations. So first, let's talk about the requirements of an S corporation. And this is from the IRS. In order to be an S corporation, you must be a domestic corporation, meaning a domestic business entity here in the United States, have only allowable shareholders, that's individuals, trust, and estates. Another corporation cannot be a shareholder of an S corporation. You can have no more than 100 shareholders, have one class of stock, and not be in an eligible corporation, meaning a foreign corporation. So, in addition to that, if you meet all of those requirements, then you can file an S election with the IRS. And the S election is filed on Form 2553. That will actually, that's the election to make your business an S corporation. Now, that 2553 is supposed to be filed by March 15th of the year in which you would like to be treated as an S corporation. For example, if you're looking to be treated as an S corporation for 2024, then you have until March 15th to file Form 2553 with the IRS. Now, what if you can't do it before March 15th? Well, there are exceptions. And at this particular point with the IRS, the exceptions are pretty much, they are outweighing the rule. So don't worry if it's not done by March 15th. There are exceptions to the rule, and 9 times out of 10, you can still be classified as an S corporation for tax year 2024. So how does it work tax-wise for an S corporation? So, like the partnership, the S corporation files a tax return, but it does not pay its own taxes. It's what we call a pass-through entity. The income or loss passed through to the individual shareholders, and then the shareholders report their share of income or loss on their individual 1040 tax returns. So the S corporation files Form 1120S. That is the S corporation tax return. It issues Schedule K-1s to the shareholders. Just like the partnership as well, that S corporation tax return is due March 15th instead of April 15th. And if that return is filed late, then of course, the IRS will assess late filing penalties against the S corporation. Now, before we move forward, any questions in regards to the S corporation? All right. Let's move forward to the C corporation, or just a regular corporation. So the C corporation is treated like an individual for tax purposes, meaning that the C corporation is the only business model that files and pays its own taxes. And right now, the C corporation tax rate, it is a flat 21%. And that was done by Tax Cuts and Jobs Act of 2017. And it went into effect on 2018. Now, the C corporation is called a double taxation model. It is because the profits of the C corporation are taxed twofold. once at the entity level, meaning the corporation pays its own taxes, and then when the profits are distributed to the shareholders as dividends, the shareholders then have to file those dividends on their individual tax returns and pay taxes on their share of the dividends. It is the business entity that has the double income taxation model, because as we're going to go forward and we're going to see, there are many, many, many types of taxes. Any questions before we move forward?
Go ahead, Kathy.
My question is, and I think last week or week before last, when we had the session with the IRS, I asked a question about double taxation because I wasn't quite sure the meaning of that, and the answer was, so I'm sure there's more meaning to it, but the straight point answer was is that even as for instance, I'm an escort. That's that's the way I am. So one of the reasons why I chose to be an escort, because I did not want to be double taxed at the C Corp, because I don't, I don't make, that kind of money. And I know I can go up to a certain limit before that. And the direct answer was is that you're still taxed twice. It's just that with the corporation, the corporation is taxed. And then once the money is distributed to the shareholders via a K-1, you are taxed there as well. And if you issued yourself W-2s, then when you're filling out your W-2, taxed on that money. So you're taxed on the W-2 and the K-1. And if you, for some reason, before you set up your W-2s, and you at some point you issue yourself a 1099, or you're taxed on that 1099 through your Schedule C that goes to your 1099. So, which is more profitable? Which of those is more profitable?
So, and what they did is that they explained everything correctly, but the issue is that they sort of combined all of the taxes. So when we're talking about we're talking about double taxation, that is as it relates to income tax only, because of course, being a small business owner, there are several types of taxes that you're going to pay, and we're going to get into those as well. But as far as the C corporation, that is the only model that, the C corporation pays taxes at the corporate level. And then when the money is distributed, the person who receives the money has to pay either taxes on the dividends, the owners pay taxes on the dividends that they receive, or just like you said, if you perform services for the corporation as a independent contractor, of course, you will pay taxes, income taxes on the money that you receive as an independent contractor. But I think what they did is that they sort of lumped all the different types of taxes together instead of keeping them compartmentalized as income tax, employment tax, self-employment tax. But what they said was correct, but the double taxation only pertains to income tax. I hope that's clear. All right. Thank you, Ms. Kathy. Okay, so that leads me to self-employment tax. And why is this so important? I remember going back to, I had a couple clients when I first started this line of, just started being a tax attorney. And a lot of clients didn't understand, well, wait a minute, why am I paying so much in taxes? And they were Schedule C businesses. They had sole proprietorships or single member LLCs. And I had to point out to them that you're paying self-employment tax. And so the question was asked, well, what is this? What is the self-employment tax? So the self-employment tax is comprised of the Medicare and Social Security tax, pretty much the FICA package that would normally be deducted from a wage earner on your W-2. So the way it works is that if you were an employee, you, of course, your employer withholds Social Security and Medicare taxes. But what you do not know is that the employer has to match the Social Security and Medicare tax as well. And that adds up to 15.3%. Well, since if you are self-employed and if you're not, matching, if you do not have an employer that's matching what is being, matching, then you yourself have to pay that 15.3% on top of your regular income tax rate. So how it works is that self-employed individuals, that's Schedule C, and also partnership, they pay self-employment tax on the net profits that they receive from their business. So for example, if you, after all of your business deductions, you have $50,000 in net profit, you're not only going to pay income tax on that $50,000, but you're going to pay self-employment tax on that $50,000 as well. And not to get too technical, but you're going to pay 15.3% of self-employment tax on 97.35% of that $50,000 profit. And that's in addition to your income tax. And now the reason that a lot of tax preparers and a lot of accountants tell you to switch to an S corporation, because the S corporation, as a owner of an S corporation, you're not subject to self-employment tax. Now, before everybody runs out and says that, okay, let's make the S election. Now let's talk about this, because the S corporation has its own set of requirements as well. First and foremost, if you make the S election, and as a single member LLC, you can make an S election. You can choose to be taxed as an S corporation. As a multiple member LLC, you can, or a partnership, you can elect to be taxed as an S corporation. But let's go over some ground rules first. If you choose to be taxed as an S corporation, your first line of income out of the S corporation needs to be through a salary, through a W-2 salary. You become an employee of your S corporation. And that was established by court cases, because if that wasn't established by court cases and by the IRS, people would just take distributions from the S corporation, and it's not subject to any type of self-employment or employment tax. So let me repeat myself. Your first line of income out of the S corporation needs to be through wages, W-2 wages. And the amount of your wages, or the amount of your salary, has to be reasonable. So, for example, you can't call yourself the CEO of this S corporation, but then you're paying yourself minimum wage. It has to be reasonable for the job or for the position that you hold. Now, and this is important, because this is, and what we're seeing in practice is that this is the next big audit item for IRS. And I saw it before the pandemic, and it's slowly coming back as the IRS starts to hire more agents. I see this slowly coming back, that they are auditing a lot of S corporations and making sure that the owners are not just taking distributions and not calling it salary. If you are if you're just taking money out of the S corporation and it's not through a W-2 salary, whereas you're paying employment taxes, the IRS can come back and they can reclassify the monies that you're taking out as salary, as W-2 salary, and make you pay employment taxes and a bunch of penalties on those particular items. So be careful. So how do I know if my salary is reasonable? I already gave you some guidelines. The IRS says that it's based on the facts and circumstances. And what they will do is that they will, and I've seen this in practice in an audit, they will go online and they will research the average salary for the position that you hold. And once they find that salary, some of the distributions that you take, just the money that you take out of the business, they will reclassify those amounts as salary and add employment taxes onto those amounts. Now, I like to advise my clients that if you're taking distributions on a regular basis, let's say if you're taking them weekly, monthly, twice a month, that seems to be a salary. Distributions from a business are supposed to be taken from the profits first and foremost, and a distribution is not something that you take on a regular basis. Quarterly distributions, biannual distributions, annual distributions, those are acceptable, and the distributions should not outweigh your salary. So, for example, you can't pay yourself a salary of $40,000, but then take 75,000 in distributions. So, and those are just some guidelines that I give my clients, some advice that I give my clients in regards to S corporations. Because the thing is that no one wants the IRS to come in and audit your S corporation and then reclassify income as wages and just tax and then just attach a huge tax bill to your business. Any questions?
Yes, I have a question.
Yes,
So,
ma'am.
So when I first established my S corp, I said I was going to pay myself about 20% of what my business was going to make, and I felt that would be fair because of my business. When it really starts making money, that would be an opportunity for me to pay myself in the range that I made before I started running my business. Now, if my business has not made the type of money to this point that I wanted to make or I thought it would make, then should I still have to pay myself a huge salary, or could I keep it at the 20%? So if I make, let's say I make $10,000, then if I keep it at the 20%, then I would pay myself $2,000. And when I make some years, like I've made, say, over $400,000, then I pay myself 20%. Then that's gonna put me at a higher rate. But then most years I've made less than 10. But
yes, ma'am.
So I can keep that to 20%, and they won't come back and in other words, I can't pay myself that salary if I'm not making
exactly
salary. So is that fair, or should I change that formula?
And no, ma'am, that is fair, because one thing I want to stress: do not increase your salary, or do not increase your salary if your S corporation doesn't have the capacity to do so. Because I don't want anyone to create tax bills that you cannot pay, employment tax bills that you cannot pay. But that is a reasonable formula, because, of course, when you're in the building stage of a business, you want to make sure that you keep as much money in the business as you can for reserves, and also for business expenses. So, Ms. Gaines, I do think that your formula is correct, but as your business grows and as the revenue increase, and you also want to look at the bottom line, then you will be able to gradually increase your salary. But I think where you are right now is fine.
Thank you.
You're welcome. Any additional questions?
No, that was it.
Okay.
Well, you did say something about being an LLC and being and electing to be taxed as a corporation.
As an
So
as an S corporation,
as an S
yes.
corp. So what's the and you don't have to answer this now. Maybe you'll have time at the end. What's the difference between being an LLC and being taxed as a S corp, or just being an S corp? And I know that might be kind of detailed, so you can wait until after and answer that question.
Oh no, I can address it right now. So because it's a part of this whole self-employment piece and everything that we're talking about. So you can choose to be taxed as an LLC, you can choose to be taxed as an S corporation. The IRS has a streamlined method, whereas the only thing you would have to do is file that form 2553, because the LLC falls under the being one of the eligible entities. And so they've streamlined that process. So what happens is that for legal purposes and for state law purposes, you are still considered an LLC, but for tax purposes, you are an S corporation. So that means that the business will file the S corp the S corporation tax return. So the difference is that the S, if you start a corporation, the S corporation is honestly just a tax, a tax is a tax. How can I say this? The S corporation is pretty much just how the business is taxed. It's not, and that's on the federal level. So for state law purposes, there's not per se an S corporation. That's a tax classification. On the state level, you just have a corporation. And and of course, the S corporation, you can elect the S corporation tax classification. And the reason why people like the LLC and to have the LLC taxed as an S corporation, because with starting a corporation, you have a lot of corporate formalities. If you created a corporation on the state level, you're required to have a board. You're required to have, shareholders. You're required to do everything by corporate resolution. You are required to have corporate minute books. So that's why a lot of people tend to gravitate towards the LLC, because with the LLC, you don't have to have all of that. But with the corporation, you have to have the board, you have to have bylaws, you have to have corporate minutes, you have to have meetings each year. There's a lot of corporate formalities. So I think that's the big difference. Whereas on the state level, or whereas on the legal side, whereas people would gravitate towards the LLC a little bit more because it doesn't have all of those requirements. And we have one question in the chat. What tax form is used as an LLC sole proprietor when taxes are due? It is a Schedule C, and that Schedule C will be a part of your 1040 individual tax return. So you would just add a Schedule C to your tax return, to your regular 1040 tax return. Any additional questions? All right, let's move forward. So let's talk about employment taxes. One thing I will tell you, this is employment taxes. It's very deadline heavy and forms heavy on both the state and federal side. A little piece of advice. If you're looking to hire employees, and if you are not well versed in the employment tax arena, my advice would be to hire a payroll processor. It's fairly inexpensive. There are plenty out there. There's ADP, there's Paychecks, and there are even some that are recommended by your bank. I would always advise to have a payroll processor because employment tax is very deadline heavy and very forms heavy. And it's something that you have to stay on top of each and every month. We have a couple of questions. Number one, when are the taxes due? And I guess that was for the sole proprietorship, April 15th with your regular tax deadline. And then we have one, does having a W-2 employee, like part-time or full-time, help reduce self-employment tax? Not necessarily, because the self-employment taxes are, that's your portion of the employment tax. So I've seen where there are companies that are partnerships and that are single member LLCs, and they have an employee, they have employees. So what happens is that the employee wages and the taxes that they pay for that particular employee will reduce the bottom line, meaning that it will reduce the profit. But if you still have profit, you're still subject to self-employment tax. So it can reduce the self-employment tax because you're reducing the amount of profit, but it doesn't negate it. Not for you and not for you individually. Okay. You're welcome. So
on the employment taxes on that Schedule C, is it true that you're still paying that 15 point?
Yes, ma'am.
So you're paying it and you're getting credit for the other half of it, or?
Yes, ma'am. So, and I always advise my small business owners that if you're at the point whereas you are, you can pay yourself and you can pay yourself a salary, go ahead and switch to S corporation, because it makes no sense to pay yourself a salary and you're still being taxed as a sole proprietorship or via Schedule C. Because what happens is that you are double taxing yourself on the employment side. So pretty much you're going to be paying employment taxes on your salary. And then if you have profit, you're going to pay self-employment tax as well. So you're pretty much double taxing yourself on the employment side. So before you make yourself an employee of your business, switch to S corporation.
And then one other question. So as an S corp, and like I said, the two times when I really made well, I was questioning, when I set my stuff to have done. Would it be better to, in those at that time, give yourself more on W-2 and pass through to yourself less on a K-1, or is it better to to give yourself what you were giving yourself on a W-2 and go ahead and pass more through on the K-1? Because if you pass it through on the K-1, are you still paying? You're not paying no self-employment tax.
You're not paying self-employment tax. No, ma'am. You're paying straight income tax at your individual income tax rate. But there are also other tricks to the trade as well. And with if you get in that position, there's always, you can start building retirement vehicles for yourself, whereas you can put some money away tax deferred. It's going to take the bottom line off of what you're passing through on that K-1. And so there's strategies. There are things out there.
So that's the next thing that I'm going to be looking into, is setting up my insurance, health insurance through my business, as well as setting up a because right now I just have like, what do you call it, what is it, a SEP, but
Yes.
I don't fund the SEP straight through my business at this point. I just take my money and buy a SEP. But I wanted to look into setting.
Fund it through the business.
what type of entity should I talk to be able to set my business up such that I'm paying myself a retirement through that, as well as just paying myself through that, and also my health insurance and that type of stuff. And then if I pay myself a SEP or whatever type of 401k, that type of thing, at what point do I have to stop contributing to that? Can I just contribute to that as long as I have my business, or I have to stop contributing once I decide, okay, I'm going to still have my business, but I'm ready to retire, but my business is going to still run. So what type of entity do I need to set up to begin looking at, rather than paying myself after taxes, paying myself before taxes? Because once you get a certain age, then
yes, ma'am.
The reason I pay myself after taxes now is so that I don't have the burden if I should have to draw from that. But after I get a certain age, I wouldn't have to pay those taxes for drawing from that. So what talk to be able to do that?
So who holds your SEP at this particular point? You have a financial advisor?
I don't have a financial advisor. I have Vanguard, and then I have something that I do through the credit union. So I have my money through Vanguard. I used to have money in Equitable, but I just started putting it all in Vanguard. I used to have a financial advisor, but not one that I pay outside. I had one that I started doing when I was working as an employee. I used to do money similar to that, and so I just kind of kept that, and then kind of kept it going that way. But I would like to, at some point, as my business becomes more profitable, be able to do types of things to save myself some money.
Yes, ma'am. Because you're gonna need a financial advisor, because what they can do is that they can either keep your SEP, they can either set up a simple IRA, or do what we call a solo 401k plan. That will allow you to put more money away tax deferred, and it will decrease the bottom line, decrease those profits from your business.
Okay, so that solo 401 I can also make up for, maybe if I didn't put quite as much in there. If I make up for it, if I do the aggressive plan, if I make up for it,
you can. Because I think at this particular point, you can put away, it is 60 something, 63, 64, around 63 or $64,000 per year, tax deferred out of your business.
Okay.
And we have another question in the chat. If I'm self-employed part-time and work a full-time W-2 job, would that help reduce my self-employment taxes? Not necessarily, because the self-employment taxes is basically, it's based upon the profit that you receive, the profit that you make from your business. So in order to decrease the self-employment tax, you have to have more business expenses. Your bottom line has to be either minimal, below $600, or you have to operate your business at a loss. That's the only way that you can get rid of the self-employment tax. Or, of course, switch to an S corporation.
So I have a question. So if you operate your business at a loss, you can't do that. Say if you did that 3 years in a row.
Oh, the 3 out of 5 years? The 3 out of 5 years? Okay. That's actually not a law. That's an IRS administrative rule.
Okay.
And we can get past that IRS administrative rule. I've done it before.
Okay.
And it's all based upon the facts and the circumstances. And we have another question from Veronica. Hey, Veronica, what is the name of the 401k plan that I just mentioned? It is a solo 401k.
So if you operate and you say you can get around it, but if you're like, for instance, in my case, I'm an S corp, they won't come back and will they come back and reclassify my business if I operate?
No, ma'am. As a hobby, 9 times out of 10, no, ma'am. Because they're going to look at the facts and circumstances. They're going to look at the facts and circumstances of your business. Like, let's say if that's your only method of income, they're going to say, well, this is a legitimate business. If you have a brick and mortar location. So it's all based upon the facts and circumstances.
And you would have to pay yourself some, at least some salary as well, right? You wouldn't.
Now, and I'll say this: if you're an S corporation and if you cannot afford to pay yourself a salary, do not pay yourself a salary, because, like I said, what I don't want to happen is that for you to create a employment tax liability for yourself.
Because during the COVID years, during COVID, 2020 and 2021, my business did not make a lot of money. 2020, I'm sorry, 2020, 2021, 2022, and 2023, my business made substantial money. So, but actually 2023 it didn't, but 2021, 2022 it did. So, so that would be what, 2 out of 5 years that it didn't make money. Okay, so.
But like I said, I wouldn't even concern myself. I wouldn't worry about it, because, like I said, it's an administrative rule, and we could always look at the facts and circumstances, and we can always get around that.
Okay. And you're going to leave your information at the end. So if
yes, ma'am. Yes, ma'am.
And how little bit of money how much of money do you have to make? How little bit of money can we approach you? Can we say I make $2,000 a year? Can I afford you? Or
I try to be as reasonable. I try to help everybody. Like my passion of small businesses, so I try to help with as much as I can.
Okay, all right. Okay, all right. Because I mean, even I just recently found a great tax person, but I know plenty small businesses that that need tax help, and so I'm usually trying to refer people. And that's usually 15, 20 people a year that will, ask me stuff, and I say, well, talk to this person, talk to that person. So they're always looking for a great tax person, but I just picked up someone last year, and he seems to be really good. So, okay. But that don't mean there may not be some things that that I might not need. I might need as well.
Exactly. All right. Thank you, Ms. Gaines. So we're going to go ahead and move forward. We're going to finish employment tax. So employment tax is comprised of a couple different items. You have federal withholdings, and this is what the employer is required to withhold according to the employee's Form W-4. The employer is required to withhold Social Security tax. And like we talked before, the employer is matching. The employer contributes 6.2%. The employee contributes 6.2% for a total of 12.4%. And then you have the Medicare tax. The employer contributes 1.455%, and the employee contributes 1.45%, and that total is 2.9%. Okay. So once the employer withholds all of those funds from the employee's paycheck, the employer is then required to make federal tax deposits. The federal tax deposits are comprised of what is withheld from the employee's paychecks, plus the employer matches for Medicare and Social Security. Now, depending upon how much you are withholding and how much money you're withholding, that determines your deposit schedule. You can either have a monthly federal tax deposit schedule, or a what we call a semi-weekly um, uh, tax deposit schedule. So if you are withholding 50,000 or less in taxes, then you are a monthly depositor. If it's greater than 50,000, then you are a semi-weekly depositor. And what I mean by semi-weekly is that when you pay your employees, the taxes are due the next week. And typically most people pay twice a month. Now, in addition to those federal tax deposits, which you are required to deposit monthly with the IRS, you have to file Form 941, and that's the quarterly federal tax return. And that keeps track of the federal withholdings, the Social Security, and the Medicare taxes that you're withholding and submitting on behalf of your employees. That form is filed quarterly. That form is due a month after the quarter ends. So for example, the end of this first quarter is going to be the end of March. So that means that your first 941 is due by April 30th. Now, when you have employees, and let's say, and this has happened, and I have had cases where this has happened, whereas you are, you are withholding the money, but you only have enough money to actually pay the employees their net salary. And it can happen to any business. So what are you to do? Well, you can either not pay anyone, but at that particular point, you're going to have a Department of Labor issue because it is a crime not to pay your employees. So most businesses decide to pay their employees and they say, I'll worry about the taxes later. Well, what happens is that, what if later never comes? What if the business never experiences an uptick in revenues and you never pay those taxes? At that particular point, the IRS is mad because you are supposed to collect those taxes from the employee and hold them for the IRS and deposit them with the IRS. If that does not happen, then the IRS is coming to you, the business owner, and they want their money. So what they call that is the trust fund recovery. They call the penalty the trust fund recovery penalty. And the reason why it's called the trust fund is because you're supposed to hold those items. You're supposed to collect the Social Security, Medicare, and federal withholdings from the employees and hold those items in trust for the for the government, for the IRS, and turn those over to the IRS. Now, if you do not do that, they will assess the amount of Social Security, Medicare, and federal withholdings that you were supposed to pay over to them as a penalty to you personally, to the business owner, not on the business, but the business owner personally. So what this trust fund recovery penalty it's a fine charge to a responsible party who knowingly and willfully failed to pay over employment taxes withheld from the employee's wages to the IRS. So what do we mean by a responsible party? It is a person who has significant but not necessarily exclusive authority over the corporate finances. For example, the business owner. That person has to be able to decide what is paid or what is not paid. The business owner is typically listed as a responsible person because they have the authority to decide if they're going to pay the taxes or not. Willfulness is the knowledge of non-payment or reckless disregard of whether the payments were being made. So if you willfully did not pay this money over to the IRS, or if you neglected to make sure that this money was paid to the IRS, then the IRS will say that you willfully did not pay the trust fund amounts to the IRS. So, for example, and this was a real case that I had a client that got hit with the trust fund recovery penalty. They had an accountant they didn't make sure that the accountant was paying the employment taxes. They put it in the hands of the accountant. The accountant, I don't know what happened, did not make any federal tax deposits. The IRS came in and said, well, you are the business owner. You're supposed to know. It was reckless for you not to make sure that this was being paid. So not only are we going to attach this penalty to the accountant, but we're going to attach it to you, the business owner, as well. So the moral of the story is to, even though you can entrust someone to make sure that this is done, you always want to stay on top of it. Even if you hire a payroll company, people can make mistakes. Make sure that your federal tax deposits are getting made. So, as part of employment taxes, you also have federal unemployment tax as well. It's called the FUTA tax. It is a 6% on a 6%. The FUTA tax rate is 6%, and that's the federal unemployment tax. It's 6% on the first $7,000 of each employee's wages. So it equates to about $42 per employee. The FUTA is filed on a separate tax return, and that's your Form 940, and that is due on an annual basis. Actually, the FUTA tax return, the 940, is due, the one for 2023 is due by the end of this month, by January 31st. And so before we move to excise tax, as you can see, the employment tax arena is very heavy, and there's a lot to consider, and that's just on the federal side. I want to also just mention on the state side, you have state withholdings, and you also have state unemployment tax as well, called the SUTA, and those are forms that are due quarterly and monthly as well. So you have your federal obligations and your state obligations. The best way to make sure that all of those are on time, paid and on time, I would say, is through a payroll company. But like I said earlier, you want to always make sure that these items are getting paid. Go through your records, make sure that these items, that these taxes are being paid, so you can avoid the trust fund recovery penalty. So now excise tax, and we're just going to be very brief with this. These are taxes that are imposed on certain goods and services. For example, that 299.9, that 0.9 is the excise tax. That is the excise tax on gasoline that is, mandated by the government. You have alcoholic beverages, cigarettes. There's also with heavy use highway taxes for those businesses that operate 18-wheelers, tractor trailers. They are required to pay excise tax as well. And those excise taxes are reported on Form 720. And depending upon how much is assessed, you can either file quarterly, monthly, or there's also an annual requirement as well for excise tax. But if you are in a business that is subject to excise tax, I would advise, please find an accountant or tax preparer that is familiar with your excise tax and your due dates for the excise tax, and make sure that those are being paid as well, because those have very stiff penalties as well. Estimated tax payments. We talked about those little for anyone who owed $1,000 or more. We talked about those little for those vouchers that you may have received from your tax preparer. So if you owe $1,000 or more in any particular tax year, then you are required to pay estimated tax payments. Now, the estimated tax payments are typically due once every quarter. And they're due, the first estimated tax payments, for example, if you're required to pay estimated tax payments for 2024 based off of a 2023 balance, your first estimated tax payment is due when you by April 15th, when you file and pay your regular tax return. Then the next one is due, it is July 15th. Then after that is October 15th, and the final estimated tax payment is due by January 15th or by January 15th of the following year. So the goal is to make sure that you are prepaying most of your taxes. Now, will you receive a penalty if you forget to make one of those estimated tax payments? No. As long as you make your estimated tax payments by January 15th of the following year, then you are fine. You will go without penalty. Now, if you do not have a tax liability for the prior year, then you're not required to make estimated tax payments. And I always get this question: what if I have estimated tax payments? What if I'm required to make estimated tax payments? But it's a situation whereas when I file my tax returns, I paid too much. Then of course the IRS will send you a refund back. And I do have clients that they typically do not make the estimated tax payments. They just actually they take the money that they allocated for taxes, put it into a separate interest-bearing account, make money off of that, off of that money, and then just pay the tax balances in full each year. That's also an option as well. One thing I will say about the estimated tax penalty is that it's one of the lower end of the IRS penalties. So it's typically depending upon the amount that you owe, just a couple $100. And I have a question: if you file as an S Corp, do you have to pay estimated taxes? Not for the actual S corporation, but you may have to pay them individually on the individual side if you owe $1,000 or more. All right, that's it. I know I rushed through the last last couple of slides. We are a bit over time. I appreciate everyone's participation. And of course, here is my information. If you need to get in contact with me, please give me a call, send me an email. I'll be more than happy to help. And I'm going to turn it back over to Tianna.
Thank you so much, Katie. That was absolutely phenomenal. I was over here taking notes too. I got my sticky notepad and my pen. So thank you so much for teaching us. That was really great information. And thank you to everyone who has participated and has joined this class. It was really great engagement, and we always appreciate that. So thank you so much for asking your questions, putting it in the chat. And then also just sharing a huge thank you to Katie for just giving all of your expertise. We truly appreciate it. And so if you could all just share in the chat, thank you. A huge thank you to Katie as well. That'd be great. And again, this is our final class for the tax business series, small business tax series, excuse me. And we hope that you join us for our next series that we have coming up. If you are on our email subscription list, just keep an eye out for the next newsletter that we're going to be sending out with the class list for February. So thank you again, everyone. I will be following up with an email if you need any of these resources, as well as Katie's information, so that you all have it on hand. And again, thank you so much and have a wonderful day. We hope to see you next time. Bye-bye, everyone.
Thank you, everyone.
So where it said January